Hey everyone, Jonathan Wu here from SW Online Invest with our July 2024 updates. If we start with China, for the calendar year 2024, China should be able to achieve its 5% GDP growth rate. One of the biggest issues that's facing the Chinese economy is effectively the lack of confidence in the overall market, which has primarily been driven by the property slowdown that's occurred over the last 2 to 3 years. One of the things we have seen the government do, though, is that it's recently started using the term destocking of property inventory for the first time since 2016, which is effectively asking SOEs to buy up existing property inventory and repurpose it either as affordable housing or selling at a loss to consumers and therefore helping create a floor to the price. If prices find a new floor, you will then see confidence coming back to the market with property prices coming back up, transaction levels going back up, but then at the same time you will also see consumer spending pick up, which is no different to any other country. So this is something that we've been monitoring quite closely. In India, what we've recently seen is that Modi has been re-elected as Prime Minister, but the biggest issue this time round compared to his previous elections is that he did not outright win with his party, the BJP. Prior to the election, he was holding, and the BJP was holding about 310 seats, with 250 seats required for an outright majority. This time around, they only scored 240 seats and had to form a coalition, which has gotten them to about 290 seats. This creates an issue from Modi's perspective in terms of political will, because a lot of the successes that Modi has had is based on the fact that he's had an outright majority, which previous to him forming government years ago was not the case, which created a lot of red tape issues within India. Where Modi actually lost a lot of his seats in this election was actually in many of the eastern states, which is around Muslim communities, because there has been a lot of rhetoric and his policy stance has been quite anti-Muslim since he got into power. Furthermore, from an investment standpoint, one of the biggest issues that we see is that valuations are very stretched. When Modi got into power originally, the Indian share market was trading around 14 times PE. Just prior to the election, it was 18 times, and now post-election, interestingly enough, it's now over 20 times, in which we currently think the headwinds are actually quite strong, and therefore has led us to remain underweight for India across our portfolios. Back home, Australia's inflation figure still remains stubbornly high at around 4%, which is hamstringing the RBA's ability to cut rates. And in actual fact, market pundits are expecting that in August or September this year, there could actually be a rate rise. One of the fundamental problems with the inflation that we've observed is that over 90% of the inflation in Australia over the last 12 months or so has been largely attributed to inelastic spending, i.e. things like fuel costs, school fees, and food, which are effectively non-negotiable items that no matter what the cost is, you effectively spend. To make matters worse, things like insurance premiums on average across different forms of household insurance have gone up at an average rate of 28% in the last 12 months, which has led to now effectively 1 in 8 households struggling to actually afford to keep up with insurance. Furthermore, if we look at it from a GDP growth perspective, this has now come to a head with even the federal government conceding that growth is actually weak. And if it wasn't for actual net immigration into the country, which has been very strong in the post-COVID environment, GDP growth is actually going backwards. And finally, one of the things that we're also seeing is that from an investment standpoint, large cap Aussie equities is actually seeing valuations quite stretched, which is then feeding into our asset allocation objectives for the portfolios. Two key points that are coming out of the US economy is that inflation is coming down. And one of the things is that if our situation locally in Australia sees inflation staying stubbornly high, but the US inflation come down, leading them cutting rates, it's actually not a bad thing for Australia, because Australia will then have a marginally closer interest rate environment to the US, which will draw more capital onshore. Furthermore, one of the biggest risks we see on the horizon is post the most recent US presidential debate between Biden and Trump. It is highly likely, or getting more and more likely, that Trump will actually win the November election. This will be highly inflationary for the world, which will cause other impacts to globalization. Because if we follow Donald Trump's original strategy from 2016, it was all around deglobalization and the MAGA movement, which basically onshored a lot of the manufacturing back into the US, which will lead to further inflation that we've been trying to keep under control since COVID. Europe as an investable destination for us continues to be a struggle. One of the key issues is that a lot of the major economies are going through elections, and at the time of filming, the UK election just finished, and after 14 years of the Conservative Party, the British population has very loudly responded and basically delivered a landslide victory to Labour and its new Prime Minister, Sir Keir Starmer. Furthermore, France has also just had its election, and we've also seen that economy swing further to the left. Whereas in other major developed economies in Europe, including Italy and Germany, they are actually starting to float further to the right. Furthermore, we still have conflicts in the Middle East, as well as Ukraine and Russia, which causes a lot of uncertainty, and the lack of transparency overall in the direction of those economies, hamstrung by effectively democracies, doesn't give us confidence to invest in that region for the time being. From an asset class perspective, one of the up and coming or very much in vogue asset classes for investors to consider has been private credit. And private credit is obviously a very broad church of investment opportunities that is effectively deriving income from alternative sources that doesn't come from bonds or term deposits or cash. Now, these are obviously attracting quite attractive rates of interest, anywhere from 7% all the way through to mid-teens. Now, because this is a broad church and because of the simple plethora of investment options in the private credit space, the investment committee has recognized that given the rise and popularity of this asset class, that we do have to proceed with more caution than we did 2 years ago, because in many cases we're finding the risk and return opportunity for investors are certainly not quite right. And as an investment committee and as investors ourselves invested in our own portfolios, some investment opportunities we are definitely skipping because they don't make sense to us on a rational investor base. Turning to portfolios, if we look at the income booster portfolio, across our 4 different investment options within SW Online Invest, this has actually been the best performing, with its 12-month performance over 10% after fees, and the 2-year performance annualizes just under 9% per annum. Now, what we've observed is that one of the key reasons why this portfolio has performed probably unusually well is been due to the fact that underlying broader equities market has been quite volatile. And where we've built this portfolio is effectively to have an underlying strong current of consistent income, but it's differentiated income where we're drawing income from different types of asset classes, whether it be bonds or from equities or from credit or from private credit. So by mixing it all together, currently as the portfolio stands at the end of June, the running cash yield of the portfolio is registering 7.6%, which is 3.25% above the RBA cash rate. And so one of the things that we try to do, and this is again just a rough guide for investors to understand, is that we're trying to achieve around 3% higher in yield than what the RBA cash rate is trying to achieve at any point in the cycle. Because obviously as the RBA rate goes up and down, it does impact the underlying investing portfolio, whether it be investing in listed property or listing in private credit. Everything is comparable and things will rise and fall with the RBA cash rate. If we look at how we're changing up the portfolio, is that with regards to the Janus Henderson Global Multi-Strategy Fund, that has been quite disappointing within the portfolio due to the fact that it's supposedly generating an uncorrelated return of inflation plus 7% gross of fees, and it simply hasn't met that objective. While disappointing, investing is supposed to be non-emotional, and therefore from our perspective we are simply trying to switch it to more attractive opportunities. And one of those is that we're introducing the Fort Lake Real Income Fund at a weight of 10% to the portfolio, as well as increasing the Plato Australian Shares Income Fund to 15%, where Plato's effectively simplified strategy is to dividend strip companies for at least, and holding them for at least 45 days to get the frank credits flowing through to investors, which derives a better after-tax outcome, especially for investors with low marginal tax rates or is already in pension phase. Furthermore, given the fact that the commercial property space and listed property space has corrected quite significantly post interest rates in Australia moving up quite higher, we now think that that market has overall stabilized, and we therefore increased our allocation to the Cromwell Phoenix Property Securities Fund to 10%, and cash has now been quite fully deployed and remains now only at 7%. So by combining these different strategies, we think that at this point in the market, we think that an attractive cash yield ongoing at 7.6% is commensurate to the level of risk that clients are taking by investing in a portfolio like ours. And one of the key features within the actual platform is that if you want to actually derive the cash distributions within this portfolio, it can be paid automatically to your nominated cash account every quarter. So this is another attractive feature of this income booster portfolio.